Well, hello and welcome to Africa Business Weekly. I'm your host, Akin Obake. Now, from inflation to MPC decisions, it's been a packed week here in Africa where we saw Ghana deliver another major rate cut, while South Africa held its benchmark repo rate at 7%. Meanwhile, next week, we expect Nigeria to have its own rate decision. And in other stories, Rwanda saw a 7% growth in their economy with a steady inflation rate. But let's dive into this week's discussions as we join Karabo, who's waiting to give us fillers from the city of Johannesburg. It's over to you, Karabo.
South African Reserve Bank Governor Lesetja Kganyago announced on Thursday that the benchmark repo rate will remain at 7% after its Monetary Policy Committee met in Pretoria. The decision to hold rates comes against a backdrop of global uncertainty and ongoing domestic pressures following the implementation of U.S. tariffs on South African goods in August. For more analysis and market reaction, CNBC Africa spoke to a panel of experts, including Annabelle Bishop, who is the chief economist at Investec, Vishal Arama, quantitative analyst at Prescient Investment Management, as well as Albert Botha, who is the head of fixed income at Ashburton Investments.
What we're really seeing is some caution from the South African Reserve Bank in a very weak inflation environment. The print also lowers the inflation outcome likely for the rest of this year, probably to well below 4%. And of course, looking through next year as well, inflationary pressures are very, very weak. The economy is exceptionally weak. And of course, if you look at the demand pull pressures, if you will, very weak as well. Yeah. The only jump up we've had recently was on electricity, and again it's quite modest. I think that we're not getting second round effects from high electricity prices. I expected the Reserve Bank to look through that and not be overly concerned. So Godfrey, I would agree with you, it's a missed opportunity.
So from an economic perspective, what would you say about the governor's reasoning for keeping rates where they are? Does that make economic sense in this environment that we are in?
I think the governor, is finding the introduction of the new inflation target.
That's what this is about.
Yes, and I think that's being eased in, and they did make mention of the fact that inflation expectations didn't come down by as much potentially as they would have hoped. But it's early days. You often see a slow start and then a more rapid acceleration as you move towards the inflation expectations becoming entrenched much lower. So unfortunately, there is an over degree of caution, I feel, at the moment. There's no reason, I think, to really worry about inflation, given that it's absolutely flat if you look at demand. So from that perspective, I think that perhaps they're rather deferring to a November interest rate cut, but they really, I think, have unfortunately not delivered what would have been really good for markets today.
So we're paying the sacrifice ratio, let's call it, because this is the new buzzword, right? The cost of not cutting rates when you could have cut rates.
I think, the South African economy, we saw that little bit of a revision, 0.9 to 1.2. It's still a very weak economic growth environment, around 1%. What that really talks to is that it's not sufficient to create jobs. And of course, we need to see substantially fast economic growth towards 3%. Cutting interest rates by 25 basis points is not going to get us there. But it all helps. It all helps the consumer. And of course, we've seen in the United States much more action on a dual mandate, looking at both labor and growth as well as inflation. So unfortunately, there is this highly restrictive interest rate stance in South Africa. If you look at a 7% repo rate and inflation at 3.3, you're far wide of the mark of a 2 to 2.5% neutral real rate. Unfortunately, this is still constraining the economy.
And that interest rate differential has just grown by them not doing anything. Vishal, come in, your view in terms of what this non-action, let's call it this way, represents, and what perhaps the governor is looking at here. I'm suggesting, together with Annabelle, that this is about that inflation target getting to 3%.
Yeah, 100% agree, right? I think definitely, as Annabelle mentioned, it's about easing towards this new inflation target, which the governor is sort of trying to get towards. However, having said that, and agreeing completely with what was said, definitely a missed opportunity, given that inflation expectations are fairly sort of contained over the next while. So look, definitely should have been probably cutting today, but probably looking forward ahead to probably next year to possibly cutting maybe November. I mean, the farm market indicates next year is probably the next time that there is going to be cut. So we'll see, and hopefully that comes sooner rather than later.
And in more news, Walmart, the world's largest retailer, is making a bold move to further establish its footprint in South Africa. This marks a shift from its previous operation through Massmart. For more on Walmart's strategic positioning in South Africa and potential challenges ahead, CNBC Africa spoke to Robbie Proctor, investment analyst at Anchor Capital.
I think the same infrastructure is in place, whether it's the Massmart group of brands or the Walmart brand itself. So it's going to be about more than, just brand recognition alone. They're still reliant on the existing infrastructure that they have in the country.
But we also know that as Walmart, the brand would not have been as visible as it was under Massmart. And we know Massmart, before Walmart came in, had been a successful trading franchise. So what is the likelihood that Walmart will be able to carry it off this time, given that now they are putting up their name? So one would imagine there would have to be a time of brand building and all of those other things that make you familiar to the retailer.
Yes, and I think that goes to the sort of lack of details in the press release, in the fact that I think they are testing the brand here. It's certainly, given the sort of graveyard of foreign brands that have failed to resonate in South Africa, I think it's certainly not a given that Walmart, due to its sort of global recognition, can succeed on its name alone. So I think it's certainly got its work cut out, and there's a lot of examples of foreign brands coming in and rebranding a local banner and being unsuccessful.
Sure. Okay. So you make the point in your note as well about how Walmart has approached other markets. So perhaps give us a little bit of detail in terms of how that has panned out in those markets, and then we can then try and see if we can ask the question, would those approaches be successful in South Africa?
Yeah, so it had a similar strategy in Mexico and broadly across its South American operations. So it initially went in, just like it did with Massmart, bought a local retailer group. However, it didn't rebrand the primary banner there. It continued to roll out stores, but segmented the market. So the existing local banner that was in place served the sort of value discount end of the market, while Walmart served the sort of middle income or more mass market side of the market. And I think that's really what it's going to be about, is which sort of segment, which LSM will Walmart target through opening its own branded stores.
Yeah, and I was actually going to ask you the question, actually, which segment of the market do you reckon they're going to target?
I think, Walmart's model is about, food and general merchandise under one roof. So I think that does entail sort of more footfall needed into stores. And it also suits, in my opinion, the sort of middle to upper demographic that would be, probably more in line with the sort of mass market American consumer. So I expect them to actually target a slightly higher LSM than Macro and Game do today. And I think they will try and compete, say on the appliances side with the likes of, an Incredible Connection, but they do have, ShopRite growing share significantly in that sort of general merchandise space.
And those were some of the stories making headlines down south this week. Until next week, it's back to you, Akin.
Many thanks there, Karabo. Now let's join Tabitha in Kigali as she gives us updates from East Africa.
Hello, Akin, and good evening to our viewers. The Dar es Salaam Stock Exchange's market capitalization has climbed to around 22 trillion Tanzanian shillings in the third quarter of 2025, with a strong year-on-year growth across key indices. Now, to unpack the structural factors driving this momentum and more, we spoke to the CEO, Peter Naletolela.
If you look at the last quarter of 2025 and the current quarter, quarter 3, We're seeing a rally on the market capitalization of the indices, and it's driven by a couple of factors. On one part is the good performance that we've seen in most of our listed companies, and in particular, banks that are listed on the exchange have been doing well, especially the two largest banks, NMB and CIDB. But additionally, we did make some changes to our trading rules, and we went live with those on the 2nd of June this year. And the trading rules were aimed at helping with liquidity and price discovery, because what we had realized, some counters were trading off-market trades on block trades, which were very different from what was showing on the screen price. And the trading rules were aimed to change the lot size, but also to change the cap size in terms of what triggers change in pricing. And that unlocked liquidity in some of the counters like TBL, Vodacom, and Tanzania Cigarette. And as a result, because of the opening up of the liquidity, good performance for most of our companies, coupled with the fact that it was AGM and dividend payment season, led to the rally that we saw.
Yes, and on matters of liquidity there, we do see that your weekly trading turnover has been a little bit or highly volatile. So what are some of the reforms or innovations that you are maybe implementing to deepen liquidity and also at the same time reduce reliance on a handful of large trades?
Yes, Tabitha. So we've seen, in as much as liquidity has opened up, is still driven to a large extent by some of your large trades that take place. What we are doing is pushing more of our retail investors, balancing that out, because most of our retail investors have a steady trading trend compared to these large institutional investors, whereby one may be looking to exit a large position at once. And what we have managed to achieve is that year on year, we've seen an increase, for example, in our mobile trading platform uptake from around 607,000 last year to 703,000 this year. And most of the new investors are actually active traders, and it's helped spur our activity in the retail space. If you just single out normal trades, take away the block trades, currently, if you look at year to date, our turnover from this mobile trading platform is around 64 billion compared to 147 billion of the normal trade flows that we're seeing. So it's a significant portion compared to the whole of last year. Total flows that we saw for mobile trading platform was 14 billion. So these initiatives that you're doing in bringing more retail investors, pushing more our mobile trading platform, is helping balance out that volatility that you're seeing long term.
Yes, and also looking at the competition that we are seeing here, we are seeing actually a competition with government securities. So as DSA, how do you position yourself to remain competitive in this environment?
So this one structural change that we have in Tanzania and most of the exchanges around the region. And the good thing is, despite the government's securities paying high yields, we still have corporate bonds that are being issued that all have been heavily oversubscribed. So at least there is still some appetite happening on the corporate bond space. And on the flip side, on the equity space, what we have been encouraging listed companies to doing, and what we as an exchange are doing, is having more regular engagements with our investors.
Rwanda's economy grew by 7.2% in the first half of the year, slightly above the East African average of 5.5%. Inflation has remained steady within the target band, following the central bank's 50 basis point repo rate hike to 6.75% in August. For more on the state of the economy, we spoke to Theory Kalisa, chief economist at the National Bank of Rwanda.
What was presented today at the Monetary Policy and Financial Stability Statement is the state of the development, recent development, economic and financial, for the first 6 months of this year, 2025, a bit of an outlook and basically an overview of what's going on. So I can say that on the side of our economy is doing well. We have data from the National Institute of Statistics that was released yesterday after an exercise of rebasing of GDP based on the most recent prices of 2024. It was found that the first half of the year, our domestic economy grew by 7.2%, which is quite a good growth if you look at what's going on internationally, with subdued economic growth at 3%. A bit better for our continent. Sub-Saharan Africa growth is around 4%. Our East African region is at 5.5%. So you can see that Rwanda is one of the countries with the highest growth. this year, and 7.2% is quite good. This growth is coming from the services sector, financial sector, including that we're discussing, is performing very well. ICT, but really, especially also the trade services. So on the side of industry, the growth is coming from the construction sector, and we have a good performance of export crops in the agriculture sector, especially coffee, despite a modest performance of the first season A of agriculture, local domestic production. So that's in terms of our economic growth. Now, our performance in terms of trades, we registered a better performance than last year, with especially in the second quarter, with a very good performance of exports, driven by coffee, as I was explaining, also minerals. We have some of these traditional commodities that we export. The prices internationally are quite good, but we also increase the volume in terms of production. We have also a good performance of other manufactured products that we export to the region, especially if you look at products like cooking oil with flour. So these are the drivers of our exports. And because of that and a modest growth in imports, our trade balance is slowing. The trade deficit increase is slowing down. Actually, in the second quarter, we had a reduction of this trade deficit. This, together with other things like the broader, global weakening of the US dollars, and also domestic foreign currency reforms, have led to a Rwandan franc that is more stable compared to the dollar than it used to be in the past 2 years because of the shocks we faced. And the depreciation is at 2.9% the first 6 months versus something more than 3.7% the same period last year. So inflation is contained within the band of 2 to 8%, even if recently it has slightly increased. But our forecast is that inflation remain within the band at around 7.1% 25, and next year at 5.6%.
That's it from the East. Back to you again.
A very insightful conversations there now. And in West Africa now, the Bank of Ghana has set a medium-term target of 8 plus or minus 2% for inflation by year end, citing current state of macroeconomic conditions. This target, among others, saw the Monetary Policy Committee sanction another larger than expected rate cut of 350 basis points to 21.5%, bringing the total cut to 650 basis points over 2 meetings. Now, Benjamin Boachi, chief economist at Second Stacks, joined us earlier for this conversation. Take a listen.
This has been a continued episode in the story where Ghana has done quite well, in its recovery. On the inflation side, we're seeing disinflation. That trend is continuing to prove out. And on the GDP growth side, obviously, the economy is growing at a very solid clip. So I think it's vindication for the central bank, which has maintained quite a hawkish stance. When a lot of folks were pushing for rate cuts to juice the economy, which have turned out to be somewhat unnecessary, even though, they did cut, but the differential still remains quite high. But I think the underlying growth is really, it's a very positive story, particularly with the help of the IMF and our concessionary partners. So the story's positive, and it's continuing to do very well.
Quite a positive story there, but let's look at some of the main drivers and also some of the areas of concern. I'm seeing that services sector is up about 10%. I'd love to get your take on how sustainable you think this is, and also we're also seeing that a mining contraction of about 1.8%. Do you think the extractives could be much of a drag on the economy going forward?
Well, historically, extractives have been a very important plank of the Ghanaian economy. So to see that reversal is not welcome, but I think long term, we're far more hoping for a stronger services sector than relying, as we historically have, on the extractive sector. So I imagine that there'll be a government revamp, looking at the oil sector and the gold and other extractives, because it's an important part of what we do. But I think that overall the picture is quite bright, given that services is really where you want to see growth, for the broader population and for the longer term.
But would you say it's more a cyclical recovery or more structural reforms playing out here?
It's a bit of both, but I would say that the main driver is structural. The question is if the economy is going to succumb to the cyclical reversion to poor management. Ghana has been engaged in an IMF program for over 2 years at this point, and that has really underpinned the reform program that the government, this government and the last government have undertaken, and that's really sort of imposed some discipline on the financial management and on how the government has invested. So as long as the lessons are learned, if they could even be somehow legislated in a way that sort of makes them permanent, then I think we can see some very sustained growth in this way. It always comes down to what the fiscal management looks like, down the road.
And in other developments now, with the Africa Growth and Opportunity Act set to expire on the 30th of September, African manufacturers are making last-minute attempts for an extension to AGOA. What is the fate of the U.S.-Africa trade relations in the face of a major shift to trade policies with Africa? Luz Mara de la Mora, Director of International Trade and Commodities at the UN Trade and Development, joined us earlier for this conversation. Take a listen.
Africa Growth and Opportunity Act, which is the scheme that has allowed 32 sub-Saharan African countries to benefit from unilateral access to the U.S. market, is about to expire at the end of this month. What does that mean? That means that exports from these 32 sub-Saharan African countries will have to face not only the reciprocal tariff that the U.S. has already in place for some months, but also the MFN tariff, meaning that the access to the U.S. market will be more expensive. This has implications for exports of Africa. The implications may be that as a result of not having preferential access to the U.S. market, the competitiveness of products coming from these countries to the U.S. market may be more expensive, and that may reduce their capacity to have the kind of market access that they used to have before. And also, given that the U.S. has been imposing different levels of tariffs to different countries, we will have to assess what will be the new competitive position of AGOA beneficiaries with respect to third countries that may also be producing similar products in the agricultural sector, commodities, minerals, of course, apparel, and some other products.
But how significant do you think this will be for African economies that have already integrated into the U.S. supply chains?
Well, Africa has proven to be a very reliable partner to the U.S. in a number of sectors: apparel, leather products, auto parts, minerals, steel, aluminum, fertilizers, and a few others. So Africa, since sub-Saharan African countries since the year 2000, have been participating in the U.S. market. They have learned how to produce for exports, how to produce for the U.S. market, how to comply with non-tariff measures, standards. They have learned how to be part of that supply chain. So the exports from AGOA beneficiaries to the U.S., our latest data here at UNTAD says that it added up to $10 billion, which is more or less around 10% of total exports of AGOA beneficiaries to the world. So this has implications in the short term because it changes the rules that the US has for accessing its markets. And it has created an environment of uncertainty, and that obviously has an impact on investment decisions, on the possibility of firms to knowing what are the conditions in which they're going to be participating. It has implications also for jobs and for people. So we are very concerned about the fact that AGOA may not be in place any longer. But at the same time, if AGOA will cease to exist, we still think that there could be opportunities for these countries to take advantage of what they have already created in the last 25 years. They have knowledge in terms of production and exports. They have investments, they have expertise. And of course, it will not be from one day to another, but we have to see how they can still accommodate into the US market, because it is not only AGOA countries that will be losing their unilateral preferential access to the US market. It is other countries that are facing, every country is facing tariffs accessing the US market.
And this is where we draw the curtains on this episode. Thank you very much for joining us on Africa Business Weekly. You can catch all these stories and more on our website, and that's cnbcafrica.com. Until next time, stay informed and stay ahead. I'm Akin Obakeye. Thank you for watching.